Welcome to MiniWebTool. When you sign on the dotted line for a house, you're agreeing to what is likely the single largest financial transaction of your life. In everyday life, a 0.5% difference means almost nothing. On a mortgage rate, it looks completely harmless on paper, but that tiny fraction dictates significant financial consequences over time. This chart shows exactly how that tiny percentage translates into real dollars over a standard 30-year term. What starts as a single line for a $300,000 loan splits and drifts apart, eventually widening into a gap worth tens or even hundreds of thousands of dollars. Over 30 years, that gap represents a massive percentage of the original loan amount, paid purely as the cost of borrowing. Most homebuyers end up sitting at a table with multiple loan estimates from different lenders, overwhelmed by conflicting terms, varying interest rates, and complex fee structures. The human brain is practically incapable of intuitively calculating compounding interest across multiple variables on the fly. You cannot simply guess your way to the right answer. That is where the MiniWebTool Mortgage Comparison Calculator steps in. We designed this tool specifically to strip away the marketing jargon and get straight to the numbers. By letting you compare up to 4 different loan offers simultaneously, the calculator lays bare the objective, brutal math of each option. Running your numbers through this interface definitively answers the core dilemma every homebuyer faces: whether you should prioritize your monthly cash flow right now or maximize your long-term interest savings over the decades. To make this tool work for you, you need to do a little initial legwork. You have to gather actual, competing loan estimates from your lenders. Once you have those quotes in hand, say one from a credit union, another from a big bank, or a few different term lengths, you plug the raw data directly into the calculator's interface. Instantly, the calculator generates a direct comparison of your immediate out-of-pocket costs. This chart shows a side-by-side view, isolating the monthly payment row so you can instantly identify the lowest number. At a glance, you know exactly which loan offer is going to give your budget the most immediate monthly breathing room. But we have to look past month 1 and focus on the lifetime cost of those exact same loans. Watch what happens when the highlight drops down to the total paid row. The column with the lowest monthly payment actually demands the highest overall cost. The mathematical reality of lending is that a lower monthly payment almost always masks the highest total lifetime cost of the loan. By forcing these numbers into a side-by-side matrix, you prevent banks from hiding the true cost of a loan behind an artificially attractive monthly payment. Let's look at a specific scenario you can run in the tool: adjusting your loan term from a standard 30-year timeline down to a 15-year term. The immediate shock of the 15-year term hits the second you hit calculate. Your required monthly payment increases drastically. This graphic illustrates the trade-off perfectly. As the scale shifts, your monthly payment rises significantly on one side, but on the other side, the block representing your total interest over the life of the loan shrinks down dramatically. The long-term benefit of taking on that heavier monthly burden is accelerated wealth building. You generate home equity rapidly because you own the house free and clear in half the time. The short-term danger is that you heavily restrict your monthly liquidity. That higher payment can act as a serious drain on your emergency cash flow if your household income drops. Deciding on a loan term requires balancing rapid wealth acceleration against daily financial safety. The tool also maps out your amortization, which is simply the schedule of exactly how your loan is paid down over time. Looking at this schedule exposes a painful reality. Your early mortgage payments are heavily skewed toward paying the bank interest, not paying down your actual principal balance. This stacked bar chart visualizes a standard first-year mortgage payment. The bottom 80. This chart outlines how to find your optimal loan. It depends entirely on 2 variables: how long you plan to stay in the home and how much monthly cash flow you have available today. If you are a cash-strapped first-time buyer, your strategy is clear. With tight cash flow, use the tool to identify the lowest possible monthly payment to secure your housing stability. In this scenario, you surrender more lifetime interest for immediate financial survival. But for a wealth optimizer, the strategy changes. With abundant cash flow and long-term plans, find the shortest affordable term to ruthlessly eliminate total interest. The only constraint for the wealth optimizer is making absolutely sure that the higher monthly payment doesn't jeopardize your emergency fund. The ideal mortgage protects current monthly stability while moving toward a specific long-term financial target. There is one overarching rule you should take away from this. Never sign a multi-decade financial contract without looking at the mathematical alternatives side by side first. The MiniWebTool mortgage comparison calculator is free and instantaneous and immune to bank marketing tactics. Before you commit your signature to that massive stack of paperwork, you need to know exactly what you are paying for. Be sure to subscribe to the MiniWebTool channel for more straightforward, objective financial calculators and guides to help you make the right call with your money.